Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leverage finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen. Hello, everyone. Welcome back to the No More, Risk Better CreditSights podcast. My name is Winnie Cisar. I'm the Global Head of Strategy at CreditSights, and today I have one of my favorite guests, a recurring guest, maybe one of our most frequent, Mark Lightner, our Head of Special Situations Legal Research. Mark, thank you for joining me today.
Winnie, as always, it's an absolute pleasure to be here. I very much enjoy it.
I will enjoy it more when we're hanging out in Arizona, preferably in a hot tub, maybe with a drink.
Little do people know, our parents live within a mile of each other in Scottsdale, so we'll see each other over the holidays.
It's going to be a very happy holidays. But first, before we get that, we need to get through some more outlooks. And Mark, you were absolutely integral in putting together one of our most major outlook reports, our 2026 Special Situations Outlook, a collaborative report across CreditSights-Covenant Review-LFI, and also some Bixby information. Before we dive into really talking about the report, could you just walk us through the purpose of it, the structure, and how have people received this report in the past?
Yeah, sure. So when we think of special situations, it really is kind of an umbrella term for everything from low-rated credits to distressed credits to situations that have complex legal issues or the like, or as many people in the market now think of special situations to include Chapter 11 and bankruptcy. So we wanted to publish a comprehensive report that kind of captures that entire umbrella of information. And it's really broken into two overarching topics. One, it's our 2026 outlook, what we anticipate in the special situations universe for 2026. And it also goes through a number of really important events in 2025. And it's, like you noted, a collaborative effort across our entire suite of products, our entire team of professionals at Covenant Review, at CreditSights, and at LevFin Insight. So it's really a comprehensive report.
It truly is comprehensive. And I know that I always learn a lot reading all of the work from the sister companies, especially Covenant Review and LFI, and being able to get that deep dive and kind of holistic overview, I think is so valuable.
Well, and that's exactly right. One of the things that we live and breathe this every day. But one of the things is we have a lot of our colleagues who are working on very discrete issues within our universe. And it's really important, I think, even for me who, live and breathe special situations, to, catch up on what they're doing to really get that comprehensive viewpoint. And one of the things that's so great, working on this and kind of packaging it all together is you really do get that perspective.
Absolutely. All right. Should we kick it off?
Yeah, let's do that. So Winnie, you were integral in this report, as you always are. And, we have done this for several years at this point. So what are we seeing in terms of macro surprises in 2025?
Yeah, so I love doing this report because it lets me flex my LevFin muscles. I was a LevFin strategist before I was a global market strategist. And 2025 was a really interesting year, both from a macro perspective and specifically as that macro related to LevFin. Coming into the year, the strategy team had expected to see a lot of transition. We knew that we had some policy uncertainty, a new administration coming in, maybe some question marks around what Fed policy was going to look like, just given some questions about, are we going to have more inflation? Are we going to have a weaker labor market? And a lot of our expectations ended up proving pretty accurate. We had thought that trade was going to be a major driver of headlines and possibly markets as well. We had anticipated that the Fed would continue to ease, which we're recording this on Fed Day, which is why I have my J. Powell t-shirt on. They did cut by another 25 basis points today and also said that they're going to start buying T-bills as soon as, I believe it's December 12th, which is a pretty quick turnaround from QT to QE.
Yeah, we were talking about that on the floor actually when you were on TV. Is why are they doing that?
Why are they doing that? So they are buying bills because there has been a lot of stress in the funding markets as of late. And I think that they're dusting off a playbook that they had in 2019 when we also saw a lot of repo market stress. At that point, they started buying about $60 billion of T-bills. This go around, they're going to do $40 billion. So not quite as kind of extreme and aggressive, but they really want to make sure that the plumbing of the financial system remains flowing freely.
Absolutely. That's very helpful. And we were kind of thinking that's kind of where they were going. But turning back to special situations, what sectors were most stressed and were the best and worst performers of 25?
Yeah, so taking just a quick step back, special sits was really interesting this year. Really, LevFin was interesting this year because the market performed really strongly. If you look at high yield total returns this year, they're north of 8%. That is a coupon plus return. But when you start to decompose that, the distressed market actually had negative total return performance. So they're posting total return losses on the year. And so all of the performance has been up in quality. It's been with double Bs, it's been with some single Bs, and it has also been very issuer and sector driven. So when we look at total return performance, the way that you outperform in high yield in 2025 was buying double Bs, buying healthcare, and buying telecom. And it's interesting because healthcare and telecom were two sectors that had been really stressed, that had some very large capital structures with very well-known, well-understood problems. And all of a sudden, we had this turn with some positive event risks, some positive catalysts. That's especially true in telecom. And a major shout out to Davis A. Baer, our head of TMT and our high-yield media and telecom analyst, because he absolutely nailed that call, went outperform high-yield telecom at the beginning of the year. And that has been the exact right place to be. A lot of the key drivers, we have regulatory shifts. Some of them are very beneficial to issuers, especially as it relates to M&A. We've seen a little bit of a pickup in LBO announcements, but maybe not necessarily enough to worry the market overall. And then you have the single name drivers. AMC, Dish is a big one. Hertz is still a big one that have really been driving credit-specific performance within the LevFin markets.
And I should note that one of the things that we tried to do in this report, Winnie, as you know, is in addition to kind of going, into each of the major sectors and kind of discussing the implications of that, we highlight roughly a dozen or so credits just to kind of illustrate our coverage universe. And so we talk about them, we reiterate our current recommendations, and we link to relevant research. And it's really great because that's a curated list of credits that our analysts are looking at and the research they think is important that people should be reading.
Absolutely. It's a great list. And I think that the list really complements nicely our next topic of conversation, which is liability management. I was speaking at a conference last week and someone referred to LME as let me explain, which I think is very funny. And a lot of those issuers that we have in that kind of single name spotlight have either done some sort of liability management or will be doing some sort of liability management. And within capital structures, you actually have to get very precisely right where you want to play. Do you want to be in the first liens? Do you want to be in the second liens? Do you think there's any value in the unsecured? So let's talk about liability management in general, because as we've seen defaults be relatively stable, we've seen the concentration of defaults that are DDEs, oftentimes a liability management transaction, increase much more than Chapter 11 filings. So how are we thinking about what's changing in the way that both companies and then also creditors are approaching these out-of-court restructurings?
But before we do that, I have a question that I consistently talk to our friends at Covenant Review, who was very helpful in putting together this section of our special situations report. And that is, how do we define them? Are they liability management transactions or liability management exercises? And I'm just curious of what you see in the market, because what they came up with, I thought, was a little bit different than the way I think about it.
Okay. So I generally hear LME, liability management exercise. I think that they have an LMT bias, don't they?
They do. They go with LMT. So for purposes of this report, we say LMT, but it means the same thing as LME, or more colorfully, creditor-on-creditor violence for those of us who play in this space. But to answer your question, 2025 was largely an extension of what happened in 2024. We had roughly the same number of LMTs as we loosely define that term happened over the course of this year, and the methodologies were largely the same. But you may recall that we came into 2025 with a bang, because on December 31st of last year, the Fifth Circuit decided the much anticipated Serta decision. And coming out of that decision, people thought that, at least in the interim, in the immediate aftermath, that there would be a watershed change in the way we think about LMTs going forward. And that was largely because the court threw out the pre-petition, pre-bankruptcy LMT in the Serta case. And that really hasn't come to fruition. And one of the themes that has come out of 2025 is that the words in the contracts matter. And so you're not going to get large pronouncements of LMTs are bad or there's a bias against LMTs. It's really going to be a contractual case-by-case basis. So that, I think, is probably the most important takeaway here. But in making that statement, I should really plug our colleagues at Covenant Review. They're really the market experts on these issues. Our colleague Ian Fang has really hit it out of the park. He's, I think, if not one of the most leading experts on this topic. And he and his colleagues put together a 3-part webinar series on YouTube that is available for free, and it's been widely watched and reviewed. And I had the privilege of participating in the 3rd episode for that. So I hope our listeners have a chance to look at that as well. But the theme is that 2025 is largely the same as us coming out of 2024.
So let's think about court precedent, because with the Serta decision, there's a lot to consider here. How is it shaping new transactions? Are there changes to what's going on? If it's kind of more of the same from a trends perspective, what are the nuances there?
Yeah, no, again, it's largely a matter of contract. So a lot of the issues, for example, that came out of Serta can be dealt with by revising the contracts or coming up with new contract language. And that seems to be kind of the way that LMEs work, is when one seems to be challenged in court, you come up with a way to get around it from a contractual perspective, like whack-a-mole. And so 2025 has been largely an extension of that.
Fair enough. And then what's new? What should we be watching for? What should investors be watching for 2026?
So I think the most important issue in this space going into 2026 is something related to cooperation agreements. And for those of us who play in this space, a cooperation agreement is simply an agreement among creditors of a distressed company to work together and not to exercise their remedies individually. So they really came out of the concern that companies would pit creditors against creditors and use contractual provisions to disadvantage one creditor group over another. And so creditor groups have come together to form cooperation agreements. And in the last couple of months, there have been 2 lawsuits that have been filed challenging those cooperation agreements, which in many cases have become, commonplace in the market as violating the federal antitrust laws, because effectively you have groups of creditors who ostensibly are competing against each other in the market for a particular security, agreeing to, in the words of the plaintiffs in these cases, price fix and to lessen competition. And so there's 2 cases. The first was filed in October, arising out of the Selecta issues in LME. And the second relates to Optimum or Altice USA. And I know you're intimately familiar with that, and it's been all over the news for the last few weeks. In that case, it was a little different than Select. In that case, the issuer itself sued all of the creditors who had, I think 99% of them had locked themselves up as part of a cooperation agreement. And so both of those lawsuits are pending in the Southern District of New York before federal judges. And it'll be very interesting to see how that litigation plays out over the course of 2026, because it, I think, in many ways could change behavior. But I don't want to get too far ahead of us on that, but I think that's going to be one of the most important issues coming out of the LMT space in 2026.
Yeah, absolutely. I know that one of the themes that we had identified coming into 2025 was this collaborative approach to liability management. And depending on the outcome of this case, it seems like that might be a much more difficult needle to thread.
Potentially. And, one of the things, and Covenant Review has written on this, and we've talked about it in some of our research as well, is that one of the penalties for violating the federal antitrust laws is treble damages. And so in the case of Optimum, they're suing for damages related to their inability to access the markets because all of their creditors have, as they allege, effectively locked them out of the market.
I would say that given that Altice is truly one of the largest capital structures in the high yield bond and the broadly syndicated loan market, I'm not necessarily buying that argument, but I will be very interested to see how the courts rule.
They were able to borrow some money in the market recently, but they said it was at a significant premium. So we'll see where the chips fall on that. But needless to say, it is a hot topic amongst the LevFin players in the market.
And would you like to define treble damages for those of us who went to law school a long time ago?
3 times your actual damages.
3 times. That's a big punitive damage.
Yes, exactly. Which you can see why, antitrust lawyers may, try and find a lot of clients out of this.
Yeah. Should we do a career?
I know. Maybe we should go back to law.
Back to law. No, I like strategy. I'm going to stick with it. I get to do podcasts, and that's super fun. So let's transition a little bit to the broader litigation landscape. What are some of the most impactful lawsuits from 2025 that you are reflecting on during this holiday season?
Yeah, sure. So these antitrust cases are obviously super important. I think the most important litigation that potentially could rear its head in 2026 relates to Monsanto. And this is a company, a credit. Monsanto is owned by Bayer. They have over $40 billion in debt. It's owned across the pond in Europe and in the United States. It's widely held. It's an IG credit, but it has significant litigation exposure related to allegations that Roundup, which Monsanto made, causes non-Hodgkin's lymphoma. So it's the active ingredient in that is called glyphosate. And Monsanto has been the defendant in that litigation, tens of thousands of lawsuits. And in many of those lawsuits, the legal claim is that Monsanto failed to warn consumers like you and me, like my father who loves to use Roundup on anything that gets in the way, failed to warn them of its carcinogenic effects, right? And so people who have gotten this disease, unfortunately have sued and have obtained really, really large judgments against Monsanto, crippling judgments. And Monsanto has argued that no, we don't have to make that warning label because the Environmental Protection Agency effectively blessed the label that we had. So all of these claims are brought under various state laws. And they've taken this issue to the Supreme Court before, and the Supreme Court decided not to take the case. Fast forward to very recently, Monsanto has petitioned the Supreme Court again to hear their case in June, and the Supreme Court said, okay, we're interested in this case, and they signaled that by asking the Solicitor General to weigh in. And the Solicitor General is the principal lawyer of the United States government before the Supreme Court. And the Solicitor General just last week filed its long-anticipated brief basically saying, you should take the case Supreme Court, and also, not only should you take the case, you should reverse because Monsanto should not have any liability under this theory that they're asserting, which is a big deal. And so I expect that the Supreme Court is likely to look at that and probably take the case in January. From Monsanto's perspective, hopefully that case will come before the court this term with a decision in June. We'll see where the chips may fall. But, in bankruptcy circles and in mass tort circles, this is kind of the North Star case that people are looking to. And if the court doesn't take it, we've stated, Andrew Brady, who's our chems analyst, has stated that the company may have to file for bankruptcy, potentially, if they are on the losing end of that fight. So I think that's probably the most interesting issue as I go into 2026. But of course, look, there's going to be all sorts of other really interesting issues, like some of the litigation coming out of First Brands, for example, and the allegations of fraud are super interesting. It'll be really, really interesting to see where that comes out. But those are the things that I'm thinking about right now.
Yeah, I mean, I see all of the Ask an Analyst questions that come in, and poor Andrew Brady has really been getting it with the buyer questions for sure.
Yeah, no, for sure. For sure.
It's been coming in steady over the course of this year. And I think it also highlights that special situations are not just distressed, right? That's an investment grade rated company with a truly binary outcome, either files for bankruptcy or remains IG.
No, that's absolutely right. And that's kind of how I tried to set this up, our discussion today, which is the term special situations is really viewed as an umbrella term that encompasses both companies that have unique issues as well as distressed companies and bankruptcy.
Yeah. So speaking of bankruptcy, one thing that I sometimes don't appreciate as someone looking a lot at performing credit is that we do have a really strong and comprehensive bankruptcy product offering through LFI. Can you talk about it a little bit? What do we offer?
Yeah. So through LFI, LevFin Insights, we recently launched a product called Post Petition, which provides comprehensive coverage of Chapter 11 bankruptcy cases from the day a bankruptcy case is filed, which we call a petition, all the way through its emergence from bankruptcy, as well as through material and relevant appeals after a company emerges from bankruptcy. And along the way, our team of folks, and we've got some really, really great folks that the team has hired and built out. We cover hearings every day. We cover on the first day we do a full recap of the relevant petitions and the filings and what happens in court, and we provide day-to-day coverage of those cases. So it's really a comprehensive product that we've put out there that anyone can subscribe to as part of our post-petition package. And one of the things, in addition, we incorporate all the bankruptcy dockets right into our platform, so subscribers can, do their own research if they want. We also include dockets that are not bankruptcy dockets, which is a really great added perk for people. So it's a really great addition that we have. And we included in our year-end special situations report, which we've been talking about a lot, a whole section on what we call bankruptcy ongoings in 2025. We talk about some of the critical cases. We talk about bankruptcy by the numbers, which includes, advisor hires, DIP statistics, debtor in possession financing statistics. And then we do a kind of a preview of the great data that the team has collected. So we go through each of the cases that filed this year and each of the cases that emerged this year with over $200 million in funded debt. So it's really a comprehensive product that we encourage people to check out.
Yeah, it's a great product. And selfishly, I love it because I compile the default list every month for our high yield default reports. And that has made it a lot easier to just click through things. And then it also highlights defaults outside of just the specific high yield bond universe or even the broadly syndicated loan universe. Some of these are kind of more middle market cuspy credits that are really important and also give some good insight into what is happening outside of the big broadly syndicated markets overall.
Exactly.
All right, so let's think about 2026, the special situations bingo card. Mark, what are you putting on your kind of legal restructuring themes for your 2026 bingo card?
I think we're going to have some clarity on the antitrust issues related to co-op agreements. We'll probably have a motion to dismiss or some kind of legal pronouncement around the edges about whether those are permissible or where the lines should or shouldn't be drawn. So I think that's really important. I think we're going to have some clarity on the Monsanto issues that I talked about. I think there's going to be some important and interesting issues in fraudulent transfer litigation that's going to come out in 2026. So we're going to be very focused on that. And lastly, I think we're going to see some interesting issues related to mass torts. The ongoing liabilities for 3M, obviously we talked about Monsanto, are not going away. And PFAS is really what I'm talking about with that. So that issue will continue to rear its ugly head in 2026.
Sounds like a lot to watch on your end.
Indeed.
Yeah. So on my bingo card, I think that we're really focused on sector performance because everything is trading so tightly right now. There are just a handful of sectors that are maybe trading wide of the market. And so there could be some opportunity there. For us, high yield media looks a little bit like high yield telecom did at the beginning of this year, where we could have some positive event risk. And it's the widest trading, highest yielding sector in the high yield market. So some good opportunity there. We also are a little bit more cautious on high yield energy, which as a strategist who started being a strategist in 2014, which was round one of the high yield energy rodeo that has really persisted for quite some time, I'm almost afraid to say that we're cautious on high yield energy, but Chas Johnston, our energy analyst, has a forecast for lower oil prices in 2026. Lower oil prices, not great for energy as a whole, even though the high yield energy sector is not what it was in 2014. We haven't had this overbuild. There's not a lot of excess capacity in the market, but it is a sector that I think a lot of investors have some PTSD associated with. So once they see some energy price volatility, they look at the energy bonds or energy loans and say, oh, maybe not right now. It's the sell first, ask questions later. We also think that some of the consumer sectors that have been really strong performers are not going to be as strong. We're downgrading high yield leisure. Part of this is technical. We have a Rising Star upgrade most likely coming from Carnival Cruises. That is going to kind of optically make it a little bit more difficult for the leisure sector to outperform. But also when we think about things like regional gaming and some of the more middle tier hotels, not quite as rosy of an environment overall for that sector. And then we have kind of this view of technology where we're cautious in investment grade, where so much of the AI infrastructure CapEx funding is going to need to come. Whereas in the high yield market, we're a little bit more constructive. I think you have to be careful, though. There are some good upgrade candidates there. Analyst Jordan Chalfin has been identifying those. But there's also this question around what happens with software in the advent of AI. Is that kind of a big pain point in transition? And then lastly, the chem sector. The chem sector has just been going through it for quite some time.
They have. As a special situations person, I have pinch hit in that sector quite a bit.
And it's tricky. And so we are underperformed basics. And a lot of that has to do with just chems. It seems like every management team has been saying, oh, the recovery is coming in 6 months. And it's been now like 3 years of that. So maybe it will come in 2026, but we're not necessarily holding our breath there. All right, Mark, this has been a delight.
As always.
So where can people find our Special Situations Outlook?
So they can find our Special Situations Outlook on any of our platforms. So if you're a subscriber to any of our products, it's available. It's also available on, if you go to the CreditSights.com website, it's available for free if you just give us your name and email address. So that will be available as well. And then we'll be promoting it on various social media as well.
Great. Well, and if you have questions, you can always reach out to your CreditSights Fitch Solutions sales rep. Try to get access that way. And thank you for watching. And Mark, thank you for joining. Next time, I'll see you in Scottsdale.
Thanks so much, Winnie.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.